Hi friends, welcome to the channel JIV and CIV Made Simple. In this particular lecture, we are going into dive into IIBF Foreign Exchange Certification course previous year question. Friends, you know that IIBF conducted different types of certification course, and today we are going to discuss Foreign Exchange Certification course PYQ. So let's start with the first question. So first of all, you try to answer the question yourself and then see the explanation. So the first question is in front of your screen. It says that which of the following best define the merchant export? So let's see the option. Option A says that Indian trader export goods after procuring them from domestic supplier. So option B says raw material are sourced from one nation and then exported to other. And the option C is that goods that bypass Indian territory and are directly imported from one country for export to another. Option D says export transaction where the origin and destination of goods remain the same. So let's discuss each and every option. As per option number A, Indian trader export goods after procuring them from domestic supplier. This is the common type of export but not a merchant export. Here we are dealing with merchant export. It is called normal export, right? Then this is normal export in which Indian trader buy goods from Indian manufacturer and then ship abroad. For example, a Delhi based exporter buy handmade carpet from Jaipur and export them to the USA. So this is the normal export option. So this is incorrect because in merchant export goods do not come from India. Then option B says that raw material are sourced from one nation and then exported to another. This sound close, but it is more likely a global sourcing, isn't it? It is more likely a kind of global sourcing, right? A company buy raw cotton from Egypt, process it in Vietnam and export the final product to Europe. However, in merchant export the trader do not process or manufacture anything. So that is why this option is also incorrect, because merchant export do not involve ready-made good. So merchant export involve what? Ready-made good, right? There is nothing like processing here. Now option C says that goods that bypass Indian territory and are directly imported from one country for export to the other. Yes, this is the exact definition of merchant export. You know it very well that traders simply buy from one foreign country and sell to another without the good ever entering India. For example, an Indian exporter orders electronic chips. An Indian exporter order electronic chips from Taiwan and directly sell them to buyer in Germany. So it orders from Taiwan and it sell to the buyer in Germany, right? So this is example of merchant export because the goods never entered India and are traded internationally. And option D says that export transaction where the origin and destination of goods remain the same. So this statement is vague and does not define merchant export. It could refer to regular export where goods move from India to other country without any intermediary role. So this option is also incorrect, right? Because merchant export always involve a middleman, like the Indian trader. Merchant export always involve the middleman, right? Some Indian exporter is there, Indian trader is there, but goods never physically enter India. So that is why option number D is also incorrect, and option number E says that none of the above. So none of the above is also incorrect because since we found the correct answer to be option number C. So what is the key takeaway? Let's summarize what we have learned in this particular question. We have learned that when we talk about merchant export, it means we are buying from one foreign country and selling to other without good entering India, right? For example, Indian trader buy goods from China. So you buy goods from China, right? Indian trader buy goods from China and directly sell them to the buyer in USA. The goods is not entering India. So it is first thing we learned it that. Second thing we learned it that this is not a normal export because normal export involve Indian product. Also there is no trade of raw material. Merchant export deals in finished goods, not raw material. Always remember, merchant export always deals in finished goods. There is nothing called raw material involved here. That is why we can say that option number to this particular question, option number C is the correct answer. Now let's see the next question. The next question is, let me show you. When should the bill of entry be submitted for import made on usance term? So these are the 5 options given before you, right? So this question is about bill of entry. So option A says that once the goods arrive in India, exactly on the due date of payment bill. Option C, at the time of making an advance payment for import. Option D, either on or before the due date when the payment is scheduled. Option E, all of the above. So very good question it is. So let's go through the first option. The first option we have once the goods arrive in India. You know, it seems logical, but it is not always correct. You know, when goods arrive, they go through customs, but that does not mean that bill of entry must be submitted immediately. For example, if a company import machinery from Germany, so suppose this is Germany, right, and a company import machinery, right, company import machinery from Germany, and the shipment arrives in India, but the payment is due after 90 days. 90 days is a usance term. So again I am repeating that a company is importing machinery from Germany, the shipment arrive in India, and payment is due after 90 days, which is the usance term. So the bill of entry is usually required when making the payment, not just when the goods land, right? So when the goods arrive in India, this is incorrect, because submission is linked to payment due date, not just arrival, right? Then option B says that exactly on the due date of the payment bill. Yes, this option is partially correct, but it is risky. If the importer wait until the exact due date, any delay in documentation might cause compliance issue or penalty. Let me give you an example to substantiate it. For example, suppose an importer has a 60-day credit period. 60-day credit period, right? Importer has 60-day credit period for an import from China and submit the bill of entry exactly on the day 60. He submit bill of entry exactly on day 60. Any process delay could cause legal and financial issue. So that is why it is also incorrect, because submission should be on or before the due date, not just exactly on it. Option C say at the time of making an advance payment for import, right? So this apply to advance payment, but usance import do not require advance payment. You see clearly written usance term. When I say usance term, it does not require advance payment, right? Usance means deferred payment. Whenever I say usance, one thing that should strike your mind that it is deferred payment, right? It is what? It is deferred payment. You should know it. So it is a deferred. It is a contents. What we know that this usance is means deferred payment. So this situation does not apply. We are talking about option number C, right? So for example, if the importer pay upfront before receiving the goods, it is side transaction, not a usance transaction. So that is why option number C is also incorrect, right? Because usance term allow payment later, not in advance. Option D said either on or before the due date when the payment is scheduled. Yes, this is the correct answer. Trade regulation require bill of entry to be submitted before or on the due date to ensure a smooth financial transaction and compliance. For example, an Indian company imports electronics from Japan with 90-day usance period. So this is Japan, right, and it has imported electronic item with 90-day usance period. So the payment is due on payment is due on 10 October. Okay, let's take for example. So the bill of entry must be submitted on or before October 10 to avoid any regulatory issue, because this ensures compliance with foreign exchange and custom regulation. That is why D is correct, and E is not correct since we found that A, B, C are incorrect. So the option E is also incorrect. So what we have learned in this question, whenever you see this word called usance term, it means deferred payment. It completely means deferred payment, means deferred payment for import pays later, not upfront. Now second thing we learned is that bill of entry has to be submitted, right? So bill of entry submission, that it is required on or before the due date of payment. That is why option number D is correct. The third thing we learned that it is not only on arrival. Payment date matter more than the goods arrival date. So when the goods arrive, it does not matter. What matters is the payment date, and if there is a late submission, then obviously penalties and compliance issue risk is there. So I hope this make you concept clear. That is our second MCQ of this session. Now let's move over to the third MCQ. The third MCQ you can see, which were asked in the previous year question, that this was regarding a foreign bank account. A foreign bank hold an account in Indian rupees with an Indian bank for local transaction, right? So this is the condition. We have to answer which is this type of account is called. So option A Nostro, option B Loro, option C Vostro, option D foreign currency account, option E interbank account. What do you think? You should first try yourself and then listen to the answer. So let's analyze each option one by one. The first option says Nostro. When I say Nostro, it means what? It means our account with you. Right? So Nostro account is an account that an Indian bank hold with a foreign bank in that foreign bank currency. For example, SBI. So SBI want to do transaction in US, right? So it open an account with JP Morgan. In USA, holding US dollar. So SBI call this a Nostro account because it means our account with you, that is JP Morgan. Right, this is incorrect because in the question a foreign bank is holding an account in India, not the other way around. So this is wrong. Loro account. So Loro means what? Their account with you. Loro means their account with you. right? So it is used when a bank refers to another bank account. For example, Bank of Baroda refers to SBI Nostro account with JP Morgan. Then for BOB it is a Loro account. Like Bank of Baroda, it refers to SBI Nostro account with JP Morgan. So for BOB it is a Loro account. This is also incorrect because Loro account are used by a third bank to refers to another bank account, which is not the case here. Now let's see the option number C, Vostro account. Vostro means your account with us. It clearly means your account with us, right? So it is an account maintained by foreign bank with an Indian bank, Indian rupees for local transaction. For example, HSBC UK want to do business in India and hold an account in Indian rupees with HDFC Bank in India. For HDFC Bank, this is a Vostro account. So Vostro account is correct. That is why option number C is correct. Option D say foreign currency account. This is an account where a person or company hold foreign currency in Indian bank. It is not specific to foreign bank, right? So an Indian exporter might have foreign currency account with SBI to receive payment in dollar from international client. So D is also incorrect. Option E say interbank account. You know that interbank account are used for settlement between two banks, either domestically or internationally. They are not specifically Vostro or Nostro account. For example, when ICICI and HDFC Bank transfer fund between each other, they use an interbank account. So that is why E is also incorrect, right? So what is the correct answer? Option number C. So what we have learnt in this question, that Vostro account means your account with us, a foreign bank account with an Indian bank in India, Indian rupees. So this is maintained in Indian rupees, INR. Then we talk about Nostro account, which is our account with you, an Indian bank account with a foreign bank in foreign currency. Then we talked about a Loro account, which means their account with you. It is used by third party to refers to another bank, Nostro account. And finally, we talked about the foreign currency account, which is used by individual or companies for holding foreign currency. And interbank account, we know it very well. So I hope this make you concept clear. Please hit the like button if you think that this explanation was useful. And for those of you who want a study material related to the foreign exchange certification course, so you can see on our app, that is JIV and CIV Made Simple, we have made a course in which you can see the content right here. There is a separate folder for theory and MCQ PDF and a separate folder for previous year question. In the theory and MCQ PDF folder, you can see that I have added module A, module B, module C, module E, module E. Like if you go to the module number C, you can see that for every unit I have provided theory and MCQ PDF. For unit 10 also theory and MCQ PDF. Similarly, I have added MCQs for each and every module it is present. And now you can see that besides theory and MCQ PDF, we are having previous year question also, right? We are adding more PDF we are adding. So if you want to access to this course, you will see the link of the course in the description section, and it costs rupees 200 only for this entire course. For more detail, you can WhatsApp me on the number shown on the screen. Now let's come to the next question. So this is the number. You can WhatsApp me on this particular number highlighted on the screen. Now the question number 3, just wait a minute. Yeah, so question number 3 is on your screen now. I think it is 4 number question. So the question say a customer want to send money abroad through a demand draft for their child education. What exchange rate will be applied for debiting the customer account, right? So this is the question. So let me move to this question later. Before that, let me ask you one more question here. Yes, first of all, try this question. I will move to that question later. Under the Liberalized Remittance Scheme, LRS, which category of entities is eligible to remit fund abroad? Right, this is the question. Very nice question it is. So this is about the Liberalized Remittance Scheme. So first option say trust, corporate, individual, HUF, NRI. Please think answer in your mind, and now let me explain. Option is say trust. You know, trust are not eligible under LRS. Because question is asking which is eligible. Trust is not eligible. Why? Because trust are legal entity formed for charitable, educational or investment purpose. They cannot remit money under LRS. Instead, they need a special RBI approval under FEMA regulation. Imagine a charitable trust in India. He wants to donate money into a NGO in USA. It cannot use LRS, but it must seek RBI approval. Option B say corporates. See, corporates and companies are not eligible under LRS. Business and company cannot remit fund under LRS. They must follow separate FEMA rule for overseas investment. For example, a software company in India want to send money to buy cloud service from the USA. It cannot use LRS but must go through corporate remittance guideline. So this is also incorrect. Individuals, correct. Under the LRS, only resident individual, including minors. Minors are also included, right? They can remit up to how much? 2.5 lakh US dollar per financial year for a certain purpose. This includes education abroad, foreign travel, medical treatment, gift and donation, investment. For example, if an Indian student want to study in Canada, their parent can send tuition fee using LRS up to 2.5 lakh dollar per year, right? So this is option number C is correct. What about HUF? HUF are also not eligible under LRS. You know, Hindu undivided family is a legal family structure in India. It is not allowed to send money under LRS. If an HUF family wants to invest in US stock, they cannot use LRS but must follow a separate RBI rule. What about NRI? So an NRI cannot use LRS. You know, LRS only applicable to the Indian resident. NRI can remit money through using different rules under FEMA like NRE, NRO. So NRI working in Dubai want to send money to his friend in USA. He cannot use LRS but make transfer fund using NRE and NRO account. So what we learn from this question? See, every question has a learning. We must learn. We don't treat MCQ just like we read the question and we get the answer. No, every question learns, because sometimes you know that different question can be framed based on it, based on the learning we have. So the first thing we learn that LRS only allow resident individual. It only allow what? Resident individual, right? And the limit is how much? $2.5 lakh per year. Let me show you. So here I have highlighted the key point: resident individual. Limit is $2.5 lakh per year. And for education, what are the permitted transactions? You can see clearly written here, like education, travel, medical treatment, right? And you know, trust, corporation, HUF, NRI, they are not eligible. And NRI can use other guidelines, other remitting method like NRE or NRO account. I hope this make your concept clear. Now let's see the next question. The next question is, what is the maximum time allowed for completing the payment for imported goods from the date of shipment? Very nice question it is. So let's break it down. Option A says 90 days, 6 months, to 70 days, 1 year, 360 days. What do you think? So let me answer this question. Option A is 90 days. This is entirely not correct, because in some special cases payment may be due within 90 days based on trade agreement. However, the standard RBI guideline allow up to 6 months. For example, if an Indian company import raw material from China, so this is China and this is India. An Indian company imported some raw material from China, right? And their agreement states payment is due within 90 days, right? So they must pay within that time. So standard payment time is longer. Now option B says 6 months. Yes, as per RBI and FEMA guideline, importer must complete the payment within 6 months from the shipment date. This ensures timely international trade settlement. For example, an Indian, like in this previous case, from China it has imported goods, right? So suppose it has imported on 1st Jan. It has imported on 1st January, right? So they must pay by 30th June. That is the 6 month. The importer must pay by 30th June, right? That is the 6 month. That is the maximum time allowed is 6 months. 270 days is not wrong answer, right? And 1 year is also wrong, right? So the correct answer is option number B, that is 6 months. So what we have learned, that RBI allow import payment to be completed within 6 months, right? That is what we have learned from this particular question. Quite easy to understand. Let's move to the next question. So the next question is, in ITC HS classification system used for import and export, what does HS stand for? So very good question it is. So option A say harmonized structure, option B say household source, harmonized system, handling strategy, and health standard. So you know, the first option A is not correct. Why? Because the harmonized is correct, but harmonized structure is not correct. International trade classification follow a structured system. Option B say household source. Obviously this is not correct, because household source may sound related to the consumer good, but it has nothing to do with import export classification, right? The ITC HS, right, system categorize all traded goods. It categorize what? All traded goods is categorized by it, not just household related category. For example, whether Indian import machinery, chemicals, textile, the classification remain the same. Option C say harmonized system. Yes, this is correct. You know that harmonized system is a globally standardized method of classifying traded goods. So it is developed by whom? WCO, that is World Custom Organization. So this is developed by the World Custom Organization. It helps in uniform classification, tax calculation, and custom procedure. In India, it is used in the ITC HS. What is ITC HS? Let me write down the full form. ITC stands for Indian Trade Classification. Indian Trade Classification. That is the full form of ITC. Right. For example, if India export rice or import crude oil, the HS code determine taxes, duties, and trade policy for these products worldwide. So HS stands for harmonized system, a universal trade classification method. Handling strategy, this is wrong. Handling strategy deal with logistic and supply chain, not the trade classification. And last option say health standard. Obviously this is misnomer and this is misguiding, because it applies to the food, medicine, and public safety. Right. So what we learned from this question is that HS stands for harmonized system, a global trade classification system used in export and import. It is developed by the WCO, that is World Custom Organization, and help standardize international trade. In India, ITC HS is used to classify product for tax, customs, and policy regulation. right? I hope this make your concept clear. Don't forget to hit the like button if you really think that this concept was useful to you. Now let's see the next question. The next question is, as per FEMA, according to the FEMA regulation, what is the maximum amount a resident individual can borrow from a non-resident relative in USD or equivalent? Very nice question it is. Let's try to go through it. Option A says that $50,000. Option B says that $1 lakh, $2.5 lakh, $10 lakh, $5 lakh. What do you think? So first option say $50,000. You know, 50,000 is relatively a small amount compared to the FEMA actual limit, right? So suppose an NRI uncle want to help his nephew in India with a personal loan. He can send money more than $50,000 legally under FEMA regulation. Option C say that $1 lakh. So what do you think? Whether $1 lakh is correct? No. Although $1 lakh is a large amount, FEMA allow a resident individual to borrow even more from his NRI relative. So question is, how much Indian resident can borrow from his NRI relative, right? For example, if an Indian citizen want to borrow money from his NRI sister to start a business, then he can legally borrow more than $1 lakh. Option C says that $2.5 lakh. Yes, this is correct. You know, FEMA allow a resident individual in India to borrow up to USD $2.5 lakh from a non-resident relative. And you know about this loan, that this loan must be interest free. This loan must be interest free and have minimum tenure of 1 year. You should know about it. The borrowed amount can be used for personal or business purpose, but not for restricted activity like real estate investment or trading in prohibited sector, right? You should remember it. For example, if an NRI father wants to lend USD $2 lakh to his son in India for higher education, he can do so under FEMA guideline, as the limit is $2.5 lakh. Is it clear? $10 lakh, which means $1 million, is not correct. It's too high compared to the FEMA set limit, and $5 lakh is also wrong. So you must remember what we learned from this question, that under FEMA, a resident individual can borrow up to US $2.5 lakh from a non-resident relative. So here the keyword is non-resident relative, right? And the loan must be interest free and have a minimum tenure of 1 year. It can be used for personal or business purpose except for restricted activity like real estate or stock trading, and amount higher than USD $2.5 lakh. The question says that what is the current maximum all-in cost ceiling per annum for ECB in foreign currency over the benchmark rate? Option A say 100 basis point, 250 basis point, 450 basis point and 550 basis point. And option E say, let me show you, as decided by the authorized dealer, that is AD. So friends, let's answer this particular question. So option A says 100 basis point. You know, when I talk about 100 basis point, it just means 1%. This is very low limit, right? Which would make it difficult for Indian borrower to attract foreign loan. Because in ECB what we do? We take loan from foreign buyer, right? So generally ECB borrowing costs are higher than just 1% of our benchmark rate. Let me give you an example. So if an Indian company wants to borrow, suppose USD 10 million. Suppose Indian company wants to borrow USD 10 million from a foreign bank, and the benchmark rate is suppose 4%. This is the benchmark rate. So 100 BPS cap would mean the maximum interest allowed is 5%, isn't it? So this is too low. A lender may not be willing to lend at such a small margin. Option B say 250 basis point. This is also not wrong. 250 means 2.5%, right? So while this is higher than 100 BPS, it is still lower than the actual RBI limit, right? So this might not be sufficient for high risk corporate borrower who usually borrow at higher rate. Now option C says that 450 basis point. This is also wrong, right? And suppose benchmark rate is 6%, then under a 450 BPS ceiling, the answer will be 10.5%. Option D says 500 basis point. Yes, this is correct, right? As per RBI guideline, the all-in cost ceiling for foreign currency ECB is 500 BPS above the benchmark rate. So this limit help balance affordability for borrower and attract foreign lender. You know, let's take an example. Suppose the SOFR benchmark rate is 5%. Then under 500 BPS ceiling, an Indian company can borrow at a maximum rate of 10%. How 10% come? 5% is the benchmark plus 5% is the extra, right? So 10%. So RBI allow a maximum ceiling of 500 BPS for foreign currency ECB. Option E say as decided by the authorized dealer. This is not correct, because authorized dealer are banks that handle Forex transaction, right? But they do not decide the ECB cost ceiling. RBI set the limit and AD must ensure compliance. For example, a company cannot negotiate an ECB loan at rate they want. It must follow RBI 500 BPS limit. So what we learned from this question, that RBI set the maximum all-in cost ceiling for foreign currency ECB at 500 basis point above the benchmark rate. This ensures that, let me show you the writing. So what is the correct answer? Option number D, right? So what we have learned is that 500 bps is allowed by RBI, and the benchmark rate should be SOFR. What is SOFR? You know, right? SOFR, LIBOR. It can be SOFR, it can be LIBOR, or it can be any approved rate, right? And authorized dealer do not decide this limit, RBI does decide this limit, right? And the ceiling is reviewed periodically based on economic condition. I hope this make your concept clear. Now let's move to the next question. Right, so the question is, the foreign tourist visiting India wants to open a bank account for managing local expense. Which account is permitted? NRE saving account, NRO saving account, regular saving account, only a current account, no account can be opened. So what is your answer? So the correct, let me show you the option. First option say NRE saving account. You know, let's talk about it. NRE saving account, that is a non-resident external saving account. So it is for non-resident Indian. This is for NRI who wants to earn income, who earn income from abroad and want to park their foreign earning in India. Foreign tourists are not NRI. You know, a foreign tourist is not an NRI, right? They are just visitor for a short time, so they are not eligible to open NRE account. Imagine John from USA, right? He is visit India for tourism. He earned his salary in US dollar and does not have any income in India. So John cannot open NRE account because it is only for NRI who earn outside India and want to deposit in India. Option B says that NRO saving account. So this is the correct answer. NRO account is meant for foreigner who have earning or need to manage fund in India. You know that foreign tourist can deposit foreign currency which is converted to INR and it is used for local expense. However, there are restrictions on how much money can be sent back to their home country. Let's say John from Canada, right? He is traveling in India in 2 months. So he wants a local bank account to handle his expense. So he can open an NRO account depositing Canadian dollar, that is CAD, and withdraw money in Indian rupees for travel and shopping. Right, so that is why option number B is correct. Rupee saving account, this is not correct because rupee saving account is only for Indian resident. A foreign tourist is not a resident, so they are not allowed to open this type of account. Only a current account, this is also not correct. Current account are mainly for business, not individual, right? A foreign tourist does not need a current account. And option is that no account can be opened. This is wrong because foreign tourists cannot open any account. This is wrong. They can open an NRO account. So what we learned from this particular question, just let me summarize the fact. The fact is here that foreign tourists can open NRO saving account in India. NRE account are only for NRI, not for tourist. Regular saving account are for Indian ex-resident. A current account is not needed for tourist, and tourists can deposit foreign currency in an NRO account, but repatriation limit apply. They cannot repatriate the entire fund. There are limit on how much the fund they can repatriate. Now, very nice question. The next question is, what is the maximum amount of Indian rupees that a person from Nepal or Bhutan can bring into India? Very good question. So option A says 5,000 rupees. While this might seems like a reasonable limit, it is not the correct answer. There is no restriction where only 5,000 rupees is allowed for people traveling from Nepal and Bhutan. The correct rule is slightly different. So imagine Sita from Nepal is traveling to India. She thinks the limit is rupees 5,000, but when she reaches the border, she is told that she can bring in more as long as it is in the right denomination. Option B says 10,000. This is also incorrect. Option C says that 25,000. This is also incorrect. Option D says that any amount in the denomination of 100. Yes, correct. According to the RBI guideline, any people traveling from Nepal and Bhutan can bring Indian rupees into India without a specific overall limit, but it should be only in denomination of rupees 100. Higher denomination note like 200, 500 or 2000 are obviously 2000 not there. 200, 500 are not allowed. Right. So this helps regulate currency movement and prevent misuse of large denomination in cross-border transaction. Right. That is the point. And option E is 50,000. This is also wrong. Now let's see the next question. In banking terms, how is side bill under import letter of credit classified? How do you classify a side bill under import letter of credit? So this question pertains to the letter of credit. So friends, option A says that A&D, LCBR, IDBE, IUBF, and option E says that DBUF. So let's start with A&D, that is acceptance and endorsement. This refers to a process where bank accepts a bill of exchange and endorses it for further processing. So A&D means acceptance and endorsement. It is a process where the bank accepts a BOE. So this is the bank. It accepts something called bill of exchange, and what it does, it endorses it for further processing. This is typically used for documents that require approval from payment over time, not for immediate payment. For example, John, a business owner, needs to pay for goods he is importing. If his bank accepts the bill, this would fall under acceptance and endorsement, but not when it comes to a side bill. So this is not the correct classification for a side bill because we are talking about side bill here. Option B say LCBR, which is letter of credit bill register. You know, LCBR is the correct classification of side bill under LC, You know, side bill, what is the meaning of side bill? You know the meaning of side bill? It means that payment is required immediately upon presentation of the document. Once I present document, give me payment. That is the exact definition of the side bill, right? So the bank accept a letter of credit bill register to track all these transactions and ensure that payment is made on time. So basically this LCBR is what? It is a kind of reporting. It is a place to track all these transactions. For example, let me give you example of LCBR. For example, Sarah, right? Sarah, he is an importer from India, is buying machinery from Germany. She present the side bill to her bank. So she is Indian. So she is importer from India, and she is buying machinery from where? Germany, right? So what she does? She present the side bill to her bank. So suppose this is the SBI bank. She went to the bank and she presented the side bill. She presented the side bill to the bank, that is SBI. So bank will record in the LCBR, which is the letter of credit bill register. Bank will make sure that payment is done immediately once the required documents are presented. So that is why option number B is the correct answer. IDBE. IDBE is incorrect, which is import document bill for export. Bill for export. It refers to the export related document. It is not used in the case of side bill under import letter of credit. So option D says IUBF, which is import usance bill finance. This is also incorrect. This is opposite to the side bill, where payment is due immediately when the documents are presented. Side bill are not related to the time based financing, so this option is not relevant. And option E says, let me show you the option E also. Just wait a minute. Why I am telling each and every option, you know, because sometimes question may be asked from option number C, option number D, so you must know it. Option number E says that demand under bill finance, demand bill under finance, that is DBUF. You know that it refers to the demand bill that are financed by the bank, often used when the payment is due on demand with the bank financing. When this could sound similar to a side bill, it is different process because it involves financing by the bank. Let me give you an example. Suppose take an example of Tom. Tom is a person, right? I am talking about DBUF. Let us make you understand. Tom has to make immediate payment for goods, but the bank does not need to finance it. Since the payment is required right away, this is not a DBUF, but rather fall under the letter of credit bill register. So what is the key takeaway what we have learned from this particular question? Let me show you. We have learned that the side bill is required immediate payment upon presentation. You can see clearly written here. It requires immediate payment upon presentation of document, and it is recorded and tracked under the LCBR, which is letter of credit bill register. You must know it. And other options like acceptance and endorsement, import usance bill finance, demand bill under finance does not apply to the side bill because they either involve time based payment or financing. I hope this make your concept crystal clear now. Right, now let's move to the next question. That is question number 3. I hope it is. So let's see what is question C. So the question says that as per international trade regulation, within how many days should bank examine document under letter of credit? So option A say within 3 working days. Not correct, because according to the international trade rule, the time frame for bank to examine LC document is not 3 working days. Option B say 2 days. Not correct. Option C say 5 banking day. Correct. So according to the UCP 600, you know, Uniform Custom Practice 600, which governs the international trade practice, bank must examine the document under a letter of credit within 5 banking day. Right, let me give you an example. So suppose Tom is a business owner, has its goods shipped to India. When the bank receives the document, it has 5 banking day. 5 banking day, this is keyword. It has 5 banking day, right? Bank has 5 banking day to verify if everything matches the letter of credit terms. If there is an issue, the bank notify Tom in time for him to address it, right? So that is why option number C is correct. No need to see other option because we know that what is the correct answer. Now let's see the next question. Which bank is responsible for making the credit available to the beneficiary under letter of credit? So let's answer this question. Option A say confirming bank. Not correct. Confirming bank is a bank that add its own confirmation to the LC, guaranteeing payment to the beneficiary in addition to the issuing bank. However, it is not the only one directly responsible for making the credit available under the LC. In simple terms, what is confirming bank? Confirming bank provide an extra layer of security by assuring payment, but they are not the one who actually made the payment, right? So confirming bank is wrong answer. For example, let's take an example of a person. Let's say Ram, right? Ram is a seller. He has goods shipped. And his buyer confirmed the payment guarantee. While the confirming bank gives security, the actual payment comes from another source. Now, the question is who is even making the credit available to the beneficiary? Option B is a beneficiary bank. This is not correct. Beneficiary bank is the bank where the exporter holds their account. It does not handle the making of credit available directly. Rather, beneficiary bank helps the beneficiary by advising and forwarding the document to the other bank involved. So let's take for example Syam. So Siam, Siam is a beneficiary and his bank will receive the document, but the bank is not responsible for making the credit available to him. Ram need to rely on other bank for payment process. Let's see the option number C. Option number C says, just wait a minute, buyer's bank. So buyer's bank is also called the issuing bank, is the bank of the buyer that issues the letter of credit. While the buyer bank plays a central role in the LC, it does not directly make the payment available to the beneficiary. The buyer bank guarantees the payment but does not directly make the payment available under the LC. Now option D says nominated bank. Correct. This is the correct answer. You know that nominated bank is the correct answer. This is the bank that is specifically mentioned in the letter of credit. It is the bank authorized to make the payment to the beneficiary upon receiving compliant document. For example, let's take an example of Sita. So Sita, a seller, she presents document to the nominated bank as per the LC term. The nominated bank checks the document and makes payment available to Sita once everything is in order. That is why option number D is the correct answer. Option number E say advising bank. This is not correct. Advising bank is the bank that advises the exporter of the LC, while the advising bank confirms the authenticity of the LC and communicates the detail to the beneficiary. It does not make the credit available to them. For example, John is an exporter, receive an LC from his bank. The advising bank informs John that the LC has been issued, but it does not actually pay him. So this question is regarding the payment. So what we learned from this particular question, let us summarize the fact, because each and every bank is super important, right? So what we learned is that nominated bank is the bank responsible for making the credit available to the beneficiary. The bank may be advising bank or another authorized bank as specified in LC. While other banks like buyer bank, confirming bank, advising bank play important role, the nominated bank is the one that ensures payment is made to the beneficiary. This is the point which we learned now. Now let's see the next question. In case of PCFC, that is question say that in case of PCFC, that is pre-shipment credit in foreign currency account, how is the monthly interest collected from the borrower? So option A says that from the current account, option B says from cash credit account, option C says from the saving bank account, option D say by the sale of foreign currency, option E say from the FCNRB account. So let's see, analyze each and every option. So the current account is typically used for day-to-day banking transaction like deposit and withdrawal. However, when it's come to the collection of monthly interest on PCFC, the interest is not collected from the standard current account, right? Option B says from cash credit account. So this is also not correct. CC is an account often used by business for working capital need and can be in Indian rupees or foreign currency. However, just like the current account, CC is not the primary account used for collecting the monthly interest on PCFC, right? So imagine you have a cash credit account where you borrow money for your business operation, but this is not the account where foreign currency interest will be collected. From the saving account. Saving account is typically used for personal saving, and while it may earn interest on deposit, it is not used to collect interest in PCFC. And option D says that by the sale of foreign currency or debit to the EFC account. Yes, it is correct. When a business receives PCFC, the monthly interest is collected by either first option is sale of the foreign currency or debit to the EFC account, that is debiting the exporter exchange earner foreign currency account. So this method is used to avoid the complication of exchange rate fluctuation while paying interest on the foreign currency account. So let us take an example and make this concept more clear. So what is happening, let's say you are an exporter and you have a foreign currency loan for your shipment. When the loan interest is due, the interest amount is collected by converting the foreign currency you have earned through your export or by deducting it from your EFC account. So what I am telling you, you are an exporter, right? And you have a foreign currency loan. You have taken a foreign currency loan, so for your shipment. When the loan interest is due, the interest amount is collected by converting the foreign currency you have earned. Since you have exported, so you will get foreign currency. So either that foreign currency will be converted by deducting it from the EFC account, exchange under foreign currency account. And option E says FCNRB account. This is also incorrect, because although it is a type of foreign currency account, but it is typically used by NRI to hold their foreign currency deposit, right? So that is the point. So you may have FCNRB account, but if you are an NRI, but that is not the account used for collecting interest on pre-shipment credit. So what we have learned in this particular question, the key point is that PCFC, the monthly interest on PCFC is collected by either by selling the foreign currency, right, or by debiting the EFC account. I hope this make your concept crystal clear now. Let's move to the next question. A foreign student studying in India must provide a local address declaration within how many days of opening an account? Very good question, right? So option A says 7 days, option B says 15, 30 days, 6 months or 3 months. So 7 days is not correct, right? Imagine you are a foreign student arriving in India and opening a bank account. If you have to provide your address within 7 days, it might be too soon, right? 15 days is also not correct, right? 30 days is correct. According to RBI regulation, if foreign student is required to provide their local address declaration within 30 days of opening a bank account. This rule help bank ensure that they have the correct contact information for the student and can track their residential status. So the correct answer is 30 days. You must remember it, right? So this is the key takeaway. As per the RBI regulation, a foreign student in India must provide they are obviously, I told you earlier that they are allowed to operate an RO account, and they must submit their local address proof within 13 days. And if the local address is not provided within this time frame, transaction may be restricted until its compliance is met. So these are the points you need to cover. Now let's see the next question. What is the standard period within which post shipment credit, that is bill purchase or bill discounted, should be realized? Right, very good question it is. So option A says that 3 months, 6 months, 9 months, 12 months, 3 years. 3 month period is not enough for post shipment credit to be realized. Exporter are allowed a longer time. Imagine you are an exporter selling product to a company overseas. Even though the goods were shipped, the buyer might need more time than 3 months to settle the payment. 6 months is also not correct. 9 months is correct, right? According to the RBI and FEMA guideline, export bills will be generally be realized within 9 months from the date of shipment. If the payment is not received within this time, exporter must seek approval or report the delay to the bank or RBI. Suppose you have shipped a large order of goods to a foreign customer, right? So there is a foreign customer and you have shipped a large order of goods. So you have up to 9 months to receive payment. If the customer has not paid by then, you will need to get a special approval from the bank or RBI to continue the process, right? So remember it, this is the key point which we have learned, that the correct period for realizing post shipment credit is 9 months, right? So option number C is the correct answer. So friends, this was the part 1 lecture. If you want me to bring the part 2 lecture also, please write yes in the comment section. Once you write yes, it will means that you are interested in listening to my lecture and you want such type of question on more videos on such part. If you want part 2 lecture, either write part 2 or just write yes, right? So this is all for today. And if you want to join our foreign exchange operation courses, which is available on our app, that is JIB and CIB Made Simple app, you can either WhatsApp me on this particular number, or in the description section you will see the link of app. You can just install app from there and enroll in the course. This will surely help you in getting a good marks in the upcoming foreign exchange examination. Also, we have a Telegram group where previous year questions are daily posted, so do join the group. The group link is provided in the description section. So that's all for today. Thank you.